Okay, so process costing. Very interesting question here. It says, suppose that input to a process is 1,000 units at a cost of 4.5 per unit. Normal loss is 10%, which is sold at 0.9 kwacha per unit. And there are no opening or closing inventories. If actual output were 80 units, calculate normal loss, calculate abnormal loss or abnormal gain, prepare the relevant accounts. All right, so let's do this. It says process costing, right? This is a process. There's this particular process. When we say input, we're referring to the units that have been sent from the previous process. So whatever process number this one is, the previous process sent 1,000 units to this process. Each unit was valued at 4.5 per unit. Normal loss is 10%. The normal loss is 10%. So the units that you usually lose can also be sold. In any production process, there's some normal loss expected. So particularly here, 10% is usually lost, but they can sell those units at 0.9 per unit. There's no closing or opening stock. Actual output is 860 units. All right, so I'll skip these requirements here because process costing always requires us to perform some steps. For practice purposes, we are going to go through these steps. Step number one is calculating the expected output. Okay, so this one should be easy. Expected output has been given as 1,000 units. At the beginning, there are 1,000 units. Ignoring any loss, we expect to produce 1,000 units as well. Okay, so the next thing is the normal loss. Normal loss is 10%. At the beginning, there were 1,000 units sent now. At the end, they expect to lose 10%. So the normal loss is 100 units. Okay, but let's look at the question. How many units did they actually produce? Here it says if actual output were 860 units. Okay, so here we had 1,000 units at the beginning. Actual output, they processed those 1,000 units. Only 860 were produced successfully at the end of the process. So we have some losses here, guys. At the beginning, there was 1,000. At the end, they only managed to produce 860. So it's like they lost some units. The total units lost will be explained in our next step. For now, we can say expected output is 1,000 units. Normal loss is 10% of that 1,000 units. Actual loss now. Actual loss is expected output minus actual output. So these guys were expecting to produce 1,000 units. In reality, they only produced 860 units. So the total units lost are 140 units. So like I said, in every process, there are some units that are expected to be lost. Particularly for this process, 140 units were lost. Okay, so as a manufacturer, we have to plan for these losses. That's where normal loss comes in. This manufacturer planned that they'll lose 100 units. From our calculation, they lost 140 units. So it's the units that you lose in excess that we refer to as abnormal loss. The abnormal loss here, guys, is 140 units minus the normal loss. Okay, so let's go through that one. We're saying these guys planned, the manufacturer here planned to lose 100 units. In reality, they lost 140 units. So the difference is the units that they lost abnormally. Normal is within our plan, the 100 units. Above 100 units, those are the abnormal losses. So the abnormal loss here is 40 units. So let's go through to the next step. The next step is the statement of equivalent units. Okay, so we have elements, completed units. For this question, we only have two. We have the completed units or the actual output, 860. We have the abnormal loss, 40 units from our previous calculation. So input, that's the element. Actual output was 860 Abnormal loss was 40. The rule is that we have to add the abnormal loss. If it were an abnormal gain, we would have subtracted, we would have done 80 minus 40. But this one is abnormal loss. So we're doing 80 plus 40, which is 900 equivalent units. The next step is finding the cost per equivalent unit. Okay, so we have elements here, input. We only have one element, the total cost, total units, cost per unit. I'm going to explain on the total cost. Okay, so let's go here. We're going back to the question. The question says, suppose that input to a process is 1,000 units at a cost of 4.5 per unit. So we are doing 1,000 times 4.5 to get the value of input material. So 1,000 times 4.5, ladies and gentlemen, it is 4,500. The next sentence says, normal loss is 10%. We've done 10% of 1,000, getting 100 units. So 100 units can be sold at 0.9 kwacha. 0.9 per unit, that's 0.9 times now 100 units normal loss, giving us 90 kwacha. So the value of input material is 45. The value of normal loss is 90 kwacha. As per rule, we have to subtract the value of normal loss from the value or from the cost of input material. Guys, value of input material is 45. The rule says we have to subtract the value of units lost. That's 90. So getting 4,410 as our total cost. Total equivalent units is 900, coming from our previous work in here. Then we have to find the cost now for 1 unit by saying 4,410 divided by 900, getting 4.9. Next up, we have the statements of evaluation. Okay, I'll start with actual output. Actual output was 80 kisti. All we have to do is multiply with the cost per unit times 4.9, getting 4,214. Closing stock, we don't have closing stock here. Abnormal loss is 40 units. Again, times 4.9, giving us 196. The last thing is the normal loss. Normal loss was 100 units. That can be sold at 0.9 kwacha, giving us 90 kwacha. So these are the values of output, abnormal loss, and normal loss. Next up is our process account. On the debit, we have input, material, and other factors of production. So input of material is 1,000 times 4.5, giving us 45. Output from our work in here was 860 units at 4,214. Abnormal loss was 40 units, valued at 196. The normal loss was 100 units, valued at 90, giving us a balanced process account. So the process account should balance both under the units and under the costs. So this was our process account question. Hopefully you've understood. Hopefully you've gotten some concepts or principles that we can use to refer and solve other process costing accounts.